Hey, welcome to our latest explainer. We've talked a lot about bonds, but today we're diving into one that can be a real game changer, especially if you're an investor living in a high-tax state.
You know the feeling, right? It's so frustrating. You make a really solid return on an investment, you're feeling good, and then you see just how much of that profit goes straight to the government. It can feel like you're just spinning your wheels.
But what if I told you there's an investment out there specifically designed to help with that exact problem? Well, let me introduce you to the municipal bond, or as pretty much everyone in the investing world calls it, the muni.
That's a great point, Mark, because when you buy a muni, you're not just buying a piece of paper. You're literally lending money to your local government for all sorts of public projects. So you're not just investing for yourself, you're actually helping to build the community right around you. But okay, let's be real here. Civic duty is awesome, it's great, but the main reason investors just flock to munis isn't only to fund a new park. It's because of two of the best words you'll ever hear in finance: tax-exempt.
Right. And this is where things get really interesting for your portfolio. The tax advantages you get with muni bonds are just so powerful. They can seriously boost your real, actual take-home returns.
So here's the deal. The interest you earn from most of these muni bonds is completely 100% exempt from federal income tax. But here's the kicker. If you buy a muni that was issued by your own state, that interest is also usually exempt from your state taxes. And that combo is what we call a double tax-free win.
Exactly. And this brings up something that every single investor needs to get their head around: the tax equivalent yield. It's so easy to get this wrong if you just look at the coupon rate on different bonds.
So let's play out a super common scenario. You're looking at your screen, you see a muni bond paying 3.5%, and right next to it, there's a corporate bond paying 5%. Now, the knee-jerk reaction is to grab that 5%, right? I mean, it's bigger, but that could be a huge mistake, especially if you're in a high tax bracket. This is exactly why you have to do the math. The tax equivalent yield basically tells you what a taxable bond would need to yield to match the after-tax return of your muni. I mean, once the government takes its cut of that 5% corporate bond, it could easily end up being worth way less than the 3.5% you get to keep from the tax-free muni.
And look, you don't have to break out the spreadsheets and do all these crazy calculations by hand. First, just know your combined federal and state tax bracket. Then, just log into your brokerage account. Almost all the major platforms have a simple tax equivalent yield calculator. You plug in the numbers, it does the work, and it tells you, plain and simple, which bond puts more cash in your pocket.
Okay, so you're sold on the tax benefits. Awesome. But how do you actually go out and find these things? Well, when you start looking, you're going to find there are two main categories of munis you need to know about.
And hey, here's a quick practical tip for you. Use the bond scanner or screener tool on your brokerage's website. The absolute key is to filter by your specific state. That is the easiest way to immediately pull up a list of those amazing double tax-free options we were just talking about.
So, as we said, there are two main types. First up, you've got general obligation bonds, or what we call GO bonds. Now, these are backed by the full taxing power of the city or state that issued them. That makes them super secure.
And the second type is revenue bonds. These are backed by the income from a specific project. Think tolls from a bridge or money coming in from a public utility. They're a little bit riskier than GO bonds, but because of that, they often come with a higher yield to make it worth your while.
And just to add a little bit of current market color here, while GO bonds are generally seen as the safer bet, the yields on some of these revenue bonds have been looking pretty attractive lately. It's definitely something to think about, depending on your own comfort level with risk. So let's tie this all together. The bottom line here is actually pretty simple. If you are in a higher income bracket and you live in a state with high income taxes, municipal bonds really aren't just an option. They should probably be a core part of the fixed income side of your portfolio.
It really is that simple. If you're looking at your investment statements and you are just sick and tired of seeing a big chunk of your interest earnings vanish to the government year after year, well, then munis are probably going to be your new best friend. It's just such a powerful tool for tax-efficient investing. So the real question you've got to ask yourself is, based on your own financial situation and your tax bracket, is this tax-free secret the right fit for your portfolio? Thanks for joining us.